Last Thursday, Egypt's Finance Minister Mohamed Mahit announced that the country is exploring other financing options just a month or two before it can reach at least a staff-level agreement with the International Monetary Fund, that's the IMF. The North African country says it is seeking to diversify its funding sources and has had discussions with some governments, such as those in Japan and China, to get cheap financing. Now, to get more insights into this, John Ashburn, global economist, Fitch Solutions, joins me from London to discuss this. Hi, John. It's good to have you here today.
Hello. Yes, good to speak to you.
John, we've seen that Egypt for the past couple of started in March, with talks with the IMF to get loans and funding. But right now, just a month or two before that, they're seeking alternative, affordable, cheap loans from China and Japan. What should we really make of this, seeing that the IMF has warned against loans from China?
Well, it's an interesting question. I think it really underlines two things. I mean, I think the first thing it underlines is the scale of the problem that Egypt faces. It has a huge current account balance deficit that it needs to fund. So Egypt is running a current account deficit of about $6 billion in the first quarter of the year. For the year as a whole, it'll probably be closer to $20 billion. That's the amount of money in investment and in funding that Egypt needs to raise in order to fund its current expenditure. And that's a lot of money to bring in. And so that's the reason why they've been going and searching for this funding from the IMF and elsewhere. And the second point, I think, is that because that's a huge amount that they need to raise, that the government's really trying to spread its risk and go over as many possible borrowers as they can. So they've gone to the IMF, as you said, they've gone to the states, the Gulf Cooperation Council, Saudi Arabia, states like that, and now they've gone to China and Japan. They're looking for as many sources as they can because they need this money quite quickly, and they need to spread it across, if possible, multiple different sources.
Now, Egypt started this 7 years ago, borrowing from the IMF, and they promised economic reforms and the rest of them, subsidy cuts and things like that. But how close are they now to achieving economic stability and the reform they're talking about? If they're still borrowing and borrowing, how close are they?
Well, they still have quite significant problems, and the biggest one is because they have this large current account deficit, they need to have dollars coming into the economy consistently to fund that. And that used to be achieved by having a lot of foreign investment by private companies. So foreigners would buy Egyptian assets, and particularly they'd buy government bonds, and that kept a flow of dollars coming into the economy. But now that flow is dried up, and the reason that's happened is because of uncertainty about the Egyptian pound, about the currency in that country. The pound continues to weaken, and as long as the pound is weakening and people think will weaken further, they're very hesitant to put money into the country because they're worried that what will happen is they'll put dollars in and then the pound will weaken and they won't get their money back. And so I think the real problem in Egypt is the continually weakening currency. And as long as foreign investors see that as a problem, see that as being the direction of travel for the currency, it's very difficult to get them back into the market. And as long as foreign investors aren't involved, that leaves the government dependent on getting funds from people like the IMF or the governments of Saudi Arabia and the UAE and states like that. So the currency is really the key problem here, I think.
So how greatly linked is this problem to the Russian-Ukraine war at the moment? And do you think it's going to abate anytime soon?
Well, you're right. It absolutely has been made worse by that. I mean, you said that Egypt's been going to the IMF for years, that there are underlying problems. But Egypt's been hit by a shock, as many countries have, of much higher commodity prices. And in Egypt's case, the one that really matters is wheat prices. The country is a big importer of food, huge population, not a lot of arable land, obviously. And so at Fitch Solutions, I mean, our estimate is just the wheat that Egypt imports will be about $1 billion more expensive as a result of the jump in food prices caused by the war in Ukraine. So that's another $1 billion on top of everything else that Egypt imports that they need to now mobilize for this reason. So they've been hit by a shock, as all countries have in the world, but we should admit that they were in a bit of a fragile position before that happened, and that's why the attention's focused on them.
And so it looks like they're going to have a bigger burden on their hands now, especially with the high interest rate environment we're going into. So how big of a burden do you think Egypt is going to be in with this?
Well, of course, every increase in debt means that they take on, as you say, more repayment burden. But even so, I think that really stresses the importance of getting funding from institutions like the IMF or maybe from the Japanese and other states, because they'll be able to get a fairly low interest rate from the IMF. The IMF obviously exists to help countries get through difficult times. Whereas if the Egyptian government sells a bond today to investors, they're paying an interest rate on that bond of 19 or 20%. So it's very, very difficult for Egypt to raise money from the capital markets in the traditional way. And so that really puts the pressure and creates the need for borrowing from institutions like the IMF, from which they can get a cheaper interest rate. But as you say, every dollar they borrow is a dollar they'll have to pay back. So this is storing up some problems for the future. Hopefully, though, if they can get money in now, they can bridge themselves to easier times in the future.
Thanks so much, John Ashburn, for your insights on the program and sharing your thoughts with us. John Ashburn, Global Economist, Fitch Solutions, thanks for coming on the program.
Thank you for having me.